Hi, it's Toby here from Track Capital. Just bringing you the latest UK house price index report from Home Track. Now, this covers the month of July, and we have another array of strong figures. It's been a common theme for this year, and you've probably heard me say it on numerous occasions, whether it's on these report videos or our podcasts. But yes, the data is very, very positive for the UK housing market in terms of house price growth. Now, what I'm going to do is look at the main headline figures here and also the summary. And if you are a little bit stuck on time, just feel free to check this part out. But I am going to go into a bit more detail for the rest of the report. So if you do have a bit of spare time, feel free to check that out as well. So let's start off with the current UK house price growth. So that figure, which is one of the main headline figures here, is sitting at plus 6%. So very strong, which is really, really good to see. And we then go on to the next two headline figures, which actually are one of the main driving factors for this house price growth being so aggressive at the moment. And the first one here is the demand for new homes is up 21%. So very, very strong demand still. And then the flow of new supply is down 3%. This is actually further down from the previous month's report, which was sitting at minus 2%. So now we come on to the summary here. So this is a summary of the report. The total stock of homes for sale is down 26% from 2020, which is an incredible figure. Actually quite shocking to see, actually. But again, it does really show why we're seeing such positive house price movement. And they are anticipating that it will remain low into 2020. So they are forecasting we're not going to see this positive trend go or slow down dramatically anytime soon, because if the demand's still there and supply isn't coming back to market, then that should carry on with the house price growth. Higher number of sales in the last year has eroded supply. So because it's been such high demand, we've seen the supply just erode out of the market, and that has been down to a rise in activity among first-time buyers and investors. Now, supply constraints are most evident for houses and properties priced up to 350,000. Reason being is obviously we're looking at these new home movers looking for space, which predominantly tend to be families, hence looking at houses and properties in that price bracket. Now, there is a mismatch in demand and supply, which, as we know, is supporting the price growth, which we've spoken about. And as we know, 6% in July, which is up from 2.3% in July 2020. So that's a big jump from July last year and where we're sitting at July this year. Average price growth for houses is at 7.6%, which compared to flats is sitting at 1.2%. So I'm just going to touch on this point here because this is something that we do cover when speaking with investors, when this sort of figure is highlighted as well, especially in these reports. So to us, that's not anything to be concerned about because, as you know, we predominantly deal with city centre apartments. Main reason being, one, is these are just averages, so they won't obviously take into consideration sort of pockets of an area or a city. As we know, in city centres where house price growth is very strong, you will only find predominantly apartments anywhere, so their growth will be different to apartments in outer city locations where there isn't as much demand. But that said, houses, of course, with the home movers that are moving at the moment, which are families searching for more space, etc., moving up the house ladder, wherever it may be, first-time buyers, that's why we're seeing houses a bit stronger. But that said, when you're looking at an investment property, well, the main aim of the investment property, of course, capital growth is there, but renting the property out. And when you're looking to rent a property out, you need to be picking locations and tenants that are going to serve you well And this is why we look at city centre or close to city centre locations, because the calibre of tenant is always going to be there. There's always going to be demand for it. You're going to get good tenants, good working professionals, etc., commuting or sort of walking into the city or being directly in the city. So that's nothing to be concerned about. You'll get steady growth, great rental demand and location, and a great calibre of tenant as well. But on to the next point. So the market is moving nearly twice as fast as 2016, with the time to sell down to 26 days, which is down from 49 days in 2019. So properties, as we know, moving very, very fast, very buoyant and very active market at the moment. One plus side with what we deal with when we're looking at off-plan and new builds is actually we don't have as much of that pressure of the properties moving and these bidding wars going on that you're seeing on the secondary market, because a lot of our developments are off market, or again, when you buy an off plan, they're not as openly marketed. So again, you're not getting into bidding wars. You're not turning up to viewing days where there's queues of people and you're fighting for properties and then paying over inflated prices. Luckily, we don't have that. We're dealing predominantly direct with developer, and then you know exactly what you're paying for. You don't pay over the odds, because you can see the price per square foot, you can see the market comparables, and it's definitely an advantage from an investment point of view when buying properties that we see in the current market conditions that we find. Because you'll speak to anybody who's out there looking on the open market and secondary market in popular areas, you're getting outbid. Sometimes you're not even getting into viewing properties, and it's crazy out there. It really, really is. You may have seen me quoted in some of the press recently as saying it's like the wild, wild west. Moving on, so we've got a chart here which shows that the demand continues to outstrip supply. So we can see the demand up just over 20%. Number of sales agreed up 22.1%. So sales agreed, if you don't know, this is where a buyer and a seller agree on a purchase and sale. So you'll see this listed on the portals such as Rightmove and Zoopla as SSTC, sold subject to contract. So this isn't actually a property completing through Land Registry. It's just a sale, as it says in its name, being agreed. So they might fall through, they might not actually take place, but this again is just demonstrating how buoyant the market is, that properties are coming to market and buyers are offering on them, and the sale is being agreed at quite a high rate there. And then when you couple in the flow of supply, which we know is down 3.2%, and then also the stock of homes for sale down 26.4%, that leads us on to the figure here that we've seen at the beginning of the report, 6% annual UK house price growth. So average house prices rose by 1.4% in the 3 months to the end of July, taking it to the figure that we see here, 6%. And they have stated here in the report that it's slightly slower in comparison to June. So July obviously sitting here at 6%, and they've got June here at 6.3%. I'll have to check this because I'm pretty sure that the June report was actually sitting around 5.4%. So I'm not sure where they've got that figure from. So maybe it's a mistake, or maybe it's a mistake on my part, but hey, mistakes do happen. The average value of a home across the UK is now sitting at £234,000. House price growth is highest in Wales, 9.4%, Northern Ireland, 9%, and then, no surprise here, the northwest of England at 7.9%. Liverpool is still topping the chart among the house price growth for the UK's largest cities. So the average home values have rose by 9.4%. So that's resulting in an average price uplift of £11,731, which is incredible. So you've now got the average price of a property in Liverpool sitting around 136,000. There's always strong growth in Manchester, as we know, and it is still continuing at 7.7%. And you've also got Belfast here doing very well at 7.5%. You'll see in the report later on, London is still trailing in terms of growth. And it's positive. It's 2.5%. Obviously not as nice when you look at the comparables of Liverpool, Manchester, and even Belfast. But it does mark a rise from 1.9% growth in March this year. So it's moving in the right direction. No surprise there, as we are seeing people move back to the city, not just for rental purposes, but also purchasing as well. As we know, the rise in home values is being underpinned by the lack of supply. So no surprise there. And they are expecting the headline rate of growth to moderate as we move into quarter four, although they're saying it won't be a linear progression. Now, they're forecasting this slowdown just due to mainly the stamp duty holiday fully ending, which is at the end of September. And we've also had part of it end already. And the fact that the government will begin to withdraw the pandemic stimulus packages such as furlough. Now, I don't think it's going to have a massive impact, but don't get me wrong, I think it will slow down slightly, but I don't think it's going to put a massive dent in the market. And as they're stating here, it may moderate it slightly. I think less than slightly, in all fairness, but that's just my opinion. They expect house prices to show an average rise of between 4 and 5% for the whole of 2021, which, yeah, there's no surprise there. It wouldn't surprise me if it actually does creep slightly over 5%, but we will see. On to the next part of the report, lower levels of supply. As we saw in the report earlier, total stock of homes available for sale is down 26%. The flow of new homes being listed, or new supply, it has been around 5% down on typical levels since the start of the year. And it's just not enough to replenish the total stock of homes for sale, which is down 26% compared to last year. So looking back, as the report does here, as a comparison, total stock is down 33% compared to this time of the year 2018 and 2019, and it's 25% lower than 2016 and 2017. So they have gone on to say that there are several factors which have come together to result in the erosion of the stock of homes available for sale. So you've got the sheer level of activity in the market. So completed sales, so this is when a property actually completes and goes through land registry, jumped by 25% in the 12 months to June compared to the same period in 2019, according to HMRC data. So that is direct data for HMRC, where completions have hit land registry. So this means 1 in 20 homes changed hands over the last year, which is incredible. That's in comparison to 1 in 25 2 years ago. Sales agreed also up again in August, as we know, but they are down compared to the peak seen in early April, but they are still running at around 21% above the levels seen in the summer of 2018-2019. So as we spoke about a lot, the reassessment of home among households searching for more space, etc., brought on by the pandemic. This sort of coupled up with the stamp duty holiday and tax savings, that has definitely resulted in the higher number of home owners looking to move. So it has created a sort of churn in the market, as obviously the normal homeowner moving up the ladder, or even down the ladder for that instance, will have a property which they'll probably be selling to then buy. So creating demand and supply. And as we spoke about previously, there's a slightly higher demand for larger family homes amid the search for space, where the stock is very, very low, and again, demand is high, pushing the house prices, as we know, up 7.6% over the last 12 months. So is this again here, you've got the graph here, which just shows the average house price growth for houses in comparison to flats as well. So if we come down here, and this is something that is very interesting. So new homes completions is down 11%. So new build properties completions down 11%, which is quite worrying. As we already know, there's a shortage of stock. We already know it's been difficult hitting the quotas needed for new properties being built year on year, and they're now down 11% in terms of completions. So again, quite concerning to see there. This also talks about a second factor in the increased levels of activity among first-time buyers, and this is down to the lenders sort of loosening their restriction, which they did tighten, and mortgage rates being a lot more favourable, along with the higher loan to values as well, which we've seen come back to the market. They also speak about the stamp duty relief, which was for first-time buyers, which again, this isn't going to push them out of the market because they still have an incentive there for stamp duty. So when the stamp duty does end at the end of September, first-time buyers are still going to capitalise on their incentive as well. And of course, demand was also surged by the investors that sort of flooded the market, taking advantage of the stamp duty holiday as well. So again, as mentioned a second ago about the new homes, so the supply of new homes has slowed this year, and that's down to the shutdown of the construction industry last year, which is obviously filtered through now, and new homes completions fell, as we saw, by 11% in England in the year to March. So this is obviously going to filter through, and although we have seen supply start to pick up again, the dip will have had an impact on the total number of homes available to buy, of course, again restricting supply which is needed. So hopefully when construction picks back up, we'll see this number get better. However, obviously we've already had a decline and it is going to take a while to filter through. We were already behind, and this has put us behind even more. So again, I don't see supply getting much higher anytime soon and being a problem for quite a while. So this part of the report here, we see them talking about the post-pandemic reassessment of home. So this is where households are deciding to change how and where they live, more space. They're being more flexible with their work now, don't have to be office-based as much, remote work, and etc., etc. So they are saying this means that higher levels of demand will still be evident moving forward, and obviously with the lack of supply, won't really change the imbalance that we are seeing, and we could see supply further restricted where people aren't seeing as much on the market, so they'll hold tight and wait for more stock to come, so kind of creating a catch-22 scenario. Now they have said moving into 2022, they believe it will be a strong start to the year in line with seasonal trends as we tend to, and then after that we will potentially look to return to a more standard or usual market with usual levels of activity among first-time buyers, with the effect of this ending of the stamp duty holiday, etc., and some buyers also still waiting for more stock to become available, will result in a slow repairing of stock levels throughout H1 next year. So moving on, the market, as we know, as mentioned earlier, is moving very fast. Average time to sell sitting around 26 days. So very buoyant market, but not like this across the board. You can see here that they've highlighted London is sitting around 56 to 75 days, Aberdeen 53 days, etc., etc. No surprise here, London, Brentwood, etc., quite expensive areas, but not only that, you'll probably see that these areas will have a lot more stock, so more choice out there for buyers, and hence they're not moving as quick, where supply is very, very limited. And here you can see that in London, this does reflect the higher level of supply as I've just mentioned, hence the longer time to sell. Moving on here, you'll see that in the slower moving markets, it's notable that price growth is also below average. Again, no surprise there. Supply and demand isn't as much as an imbalance. So you can see here it ranges from 2.5% in Reading to 3.8% in Brentwood. So moving on to the outlook, what they're saying is low supply and limited choice for purchasers may well impact demand in H2 and moving into 2022. Again, this is a similar sort of theme that we have been following and what we are predicting as well. And obviously, alongside the stamp duty holiday and the change in economic landscape with the ending of government support, etc., they will also look to see the market slow down. However, and as they stated here, it's not going to be like a straight slowdown. It will be gradual, and there's still a long way to go in this market. I mean, we don't see it being that detrimental to the market, what we're going to see here. And again, they're saying it's going to slow. So you'll probably see it go back to more normal levels, which again is still positive. It's still with prices growing, and it'll be a more settled market, which again across the board can be good because you know usually exactly where you stand, and it can be an easier market to navigate through sometimes when it is like that. So they are, as we mentioned previously, predicting house price growth to sit between 4 and 5% by the time we get to the end of the year. Now, they are forecasting, as we said, a busy start to 2022, and they are foreseeing that normal stock levels will return, and activity among movers and first-time buyers throughout H2 will also result in a slow rebuilding of stock levels as well. So fingers crossed, they've got a very positive outlook on that side of things. Now, coming along to the last part of this report. So we look here at the house price growth in terms of the country, region, and city. So here, if we look at the regions, you've got the Northwest here performing very well, 7.9%. No surprise there. Wales over here doing very well, 9.4%. And another one with a 9% is Northern Ireland. But yeah, across the board, all green, which you can see here, which is very, very positive. And if we come down here, the house price index city summary is very, very positive. So we've got here Liverpool 9.4%, topping the chart here. Manchester 7.7%, Belfast 7.5%, Sheffield 7.4%, and Nottingham 7%. I mean, I'm not going to go over this any further because again, you can see this, but yeah, very, very positive numbers here. I hope that has been informative for you. If you do want to discuss this report in any more detail, please feel free to get in contact. Email info@trackcapital.co.uk, and we'll be more than happy to answer your questions. I'm Tobi from Track Capital. Thanks for watching.